Hey, welcome to the closing beat, everybody. Happy Wednesday to you. How you doing? I'm having one of those days, let's be honest with you. I'm having one of those days where I slept good, like hard, just woke up. They're fixing my house in the back there, so I woke up to that. But I slept so good, I woke up, I'm like, oh, my face, like it won't wake up. So if I look a little older today, well, that happens too. But man, I slept hard. Anyways, welcome to our show. We are financial advisors that apparently will tell you anything about us. We are fully transparent fiduciary advisors. Of course, you can ask us anything, any question. Happy to answer it. We just like approaching things that way, so there's no issues there. While other advisors are playing checkers, we're playing chess. And a really cool thing I got to work with is somebody. What if you had a concentrated stock position, which is just a fancy way of saying you've got one stock that makes up a lot of your net worth? What if we could make your income low enough, sell off enough of that stock to reduce the position and pay zero capital gains on it, craftily kind of like, doing it that way, but still keeping some stock for the future because they are very confident in this stock and they want to keep it. So really fascinating, like balance of dollars there I got to work with. I did enjoy that and even took Chris through it as well. Wine and Wealth, we have got really great classes, actually. I'm not just saying this. Really great ones this year for clients. Last week we did our February financial focus. What is it that you need to conquer in February? I'm not talking about putting money away. I'm not talking about the general stuff. Like, what is the focus? Let's get it done and how we can help. Tomorrow we got Wine and Wealth coming up. We are going to talk about there are tricks in the 401k, 403b, world that people don't know. And we're going to go over them, along with a few updates as well. So we'll get into the geekiness with that. It's been a while since we've had some geeky talks. We will do that, of course. And if you want to be a client, come check us out at jazzwealth.com. All right, let's talk about the stock market here today. We've got a lot of earnings to go through, so it may just be like a stocks in the news type day. But here we go. The S&P, largely, and I'm happy with this. I'm not complaining, but largely a lot of participation across the board. It wasn't just the, whatever they're calling them today, FANG stocks, Magnificent Seven, whatever it is. It wasn't just them. Broadly across not everybody, but we had a lot more participation. That's what creates, by the way, always exciting to see this. Check this out. I'm going to take you over to, I'll use the SPY. So if you want to play along too, you can do this. That's what creates these types of days. We start with a gap higher today, little bit of early morning action. That's very common. There's always that 9:30 to 10 a.m. They call it a reversal time where a lot of orders are going through, people are making decisions. And then look, no real volatility. It's hard for the stock market to be volatile on a day when there's a lot of participation. Notice that? If you see one of those days where you're whipping back and forth and stuff, it's usually because the big guys over here that control 35% of the S&P were up, and then there was some news, and then Elon Musk said this, and Jeff Bezos, whatever, this and that, and Tim Cook and all. Well, so then you get that volatility. When you have everybody participating, there's so many people in the ocean that it can't, right? There can't be enough volatility. There's not enough room. So I love seeing things like that. Obviously, I'm fairly motivated by that because that's a strong, consistent, and decided market for the day. So we love that kind of stuff there. Now, you don't want it to get overboard, right? We've seen what happens when the stock market gets a little too far too fast. It will take a break. It will pull back and, kind of be boring. I'll take the slow, boring uptrend all day long and every day long. Hey, the NASDAQ can say the same thing today for the most part. If you look inside the NASDAQ, I'm going to say real estate, but like the tech-driven real estate because it's in the NASDAQ, right? Okay, not so exciting there, right? Rates flopping around and doing their thing. But other than that, the NASDAQ itself kind of got to enjoy the same type of day. Just a lot of participation, consistency, bullish behavior. Everybody's optimistic to at least enough of a degree that gets you going there. So the NASDAQ did great. You've got the Dow hinting at making new highs. By the way, the Dow is in third place this year. It is up 2.6%. If I go back for just 1 second, the NASDAQ now at 5.5% with this close at highs. So really good there. Your weakest link in there is going to be the Russell, and the Russell is very rate sensitive. And when I say Russell, I mean the Russell 2000, the small caps, right? You could look at, if someone says the Russell and they don't clarify that, like Russell 1000 is a growth kind of a thing. So anyways, Russell 2000 here, small cap stocks, it is really in tune with and being very sensitive to what interest rates are doing. If I go back over here to the interest rates, show you today, another little pullback means rates went up, means small caps are like, We don't like that. We want stable rates. We can handle higher rates, but we want stable rates. And rates have been not stable, you know. A way to sugarcoat that. So the Russell 2000 is the only major index that is down for the year. It's down about 4% right here. Actually, if we got down to this number right, close enough, right there, we'd have the Russell down about 4%. So that's okay. No big deal there. We are officially halfway through earnings season, right? 215, not counting after hours, 269 stocks have reported, I believe, over 250, right? So past the halfway point there. We've got over 100 reporting again this week in the S&P, so we're flying it through here. How's it going? From an earnings perspective, right? Then we look at two things. We look at the growth rate for the S&P, and then we look at the beat rate. Okay, so any fundamental, if you want to be real cool and like be the fundamental analysis guy and like, yeah, I'm going to sound cool in front of my friends, here's where we stand, not including after hours. 81% of the stocks that have reported have beaten Wall Street's expectations. That's not always a good thing, but that's one thing to look at there. It is officially 14% higher than the 5-year average. So we're trending better than expected, right? So earnings are coming in better than expected for the most part, and for the ones that actually matter, yeah, okay, it's good news there. Now, the earnings growth rate, this is a bit of a departure from what I was going to do, but just lessons in my head. Ready? So the earnings growth rate, meaning the total earnings of the companies that have reported so far, 8.1% growth in earnings. Okay, that's good. That's better than average too. That's better than what most everybody was expecting there. What's really cool is normally it's because, and has been because of tech. So it's like, okay, well, you know, some of the furniture stores, like they're not growing as much. They are actually, but you know, they're not going to make an impact. So usually what we find is 8.1% earnings growth rate so far in the S&P. But if you take out tech, one year it was energy because it was off the charts, right? If you take that out, tech, you go, oh, now it's not so impressive, right? That's not the case this time. Really good economic study here if you're into this kind of stuff. 8.1% growth rate. Take out tech, you now have double-digit growth rates. That's good news too. Maybe part of the reason why we saw more broad participation today, because a lot of the other names got a chance to report. Oh, you mean we don't, like NVIDIA's not the only game in town? Apple? Maybe a bad example, but you mean the top 7 stocks? Oh, those aren't the rest of them are growing too? Great. Now we got more participation. So kind of putting all that together and then back up a second, you go, okay, well then fundamentally the economy's okay, right? Soft landing. I won. I'm going to go tell Eric actually. So fundamentally the economy looks good. Growth rates are mostly strong inside of here. And the only one little like, am I wrong? Am I interpreting this wrong? The only one potential downside is, are the growth rates better because of cost savings? A little bit, right? You can dig into, I didn't dig a lot into it, ran out of time today, but you know, the layoffs, right? We're laying off people little by little. We have less overhead. We have less employment tax. We have to pay all this stuff, right? As an employer. So are we doing better because there's growth or because we saved? Like Facebook, obviously, growth, right? Thank you, Temu, right? But they're laying off people too. So is that a combination? Like you don't want to see that. You don't want to see growth because of headcount reduction. So little side note there. I got off on a tangent there. Let's go over here. Gold choppy, not much to say there. Crude oil choppy, not much to say there. Continues to be the case. We talked about bonds, interest rates, and everything like that so far. Keep in mind, the world is now looking at May, right? Loretta, she's retiring soon. I forget her last name. Meister, right? She came out pretty much guaranteed May for everybody. So now look at the changes in predictions for May rate cuts. Everybody's focused on May. So, yeah, not March, May. You wait a little bit longer. Probably pretty cool. We'll see what happens there. Man, I'm all over the place today. We'll probably cover the stocks that you want us to talk about here today. I'm going to go through a bunch of them, and if you have any questions, I will take your questions. We'll just hang out and keep doing this here. Ford, sales were $3 billion more than expected. Yeah, that earns you a higher stock price there. That's on the surface. That's the headline. You could go find a headline somewhere that will say, oh, they made $3 billion more than expected. Electric vehicles, that's a losing area for them. Has been. Nothing new there, right? They lost $1.6 billion. But that's good news, especially if you like EVs. But it's good news because they're losing less and less and less each quarter. They're figuring it out, right? It takes a while to do this. So quarter over quarter, losing less there. However, what they call ICE, or your internal combustion engines, if you're ever looking at like an analyst report, you're going to see EV and you're going to see ICE. That's how they break it down on all the sheets there. Internal combustion engine, gas. So gas versus electric. They killed it, selling a ton over there, right? And so that offset the losses and much more than that, to the point where they said, just going to give away 18 cents. If you're a shareholder of Ford, we're going to give you an additional 18 cents in the form of a dividend there. So what's that tell you? Now what do we have? Well, we've got Ford. We've got Toyota Motors. We talked about that yesterday. Crushed it, doing really well, especially overseas. General Motors, right? We're all buying cars. So very, very good news for them as a whole. And now that's a couple days of analysis, putting everything together so you can kind of see not just the stock, the industry, right? They're doing well, even though EVs are, well, you know, it's a work in progress. All right, CVS here, not so good. Stock price was higher. Oh, here's my little list. There you go. Stock price a little bit higher here, but their medical costs are what I would say are painfully high. Like the highest they've been as far back as I can look. Don't have a graphic for you, but incredibly high there. Sales were stronger, but their costs were higher, right? So it's good to see that activity, but the costs are getting a little bit higher there. What does that tell you? Is it something wrong with CVS? No. Remember Humana just the other day. Humana said the exact same thing to a point where I would have said their costs are painfully high as well. So healthcare costs all around there are just incredible. All right. You can't hear it? Well, he is going to town on that water, man. Like, do you give him water ever? Jeez. Well, speaking of waterfalls, look at Snap, 34%. You want to know something fun? I thought that was impressive. I'm like, surely this doesn't always happen. This is officially the seven quarter in a row where the response to earnings has been a decline of 5% or more. Whoa, right? Like if you're an options trader on this stock, yeah, best of luck to you. But 7 quarters in a row. And of course, this time the gap down is the largest of all of them there. Yeah, I don't know. This was not very good. If you want to skip a lot of research, daily active users, monthly active users, time spent on the platform, all those metrics, I think you can just kind of look at one thing. The guidance, you know, if you read a headline somewhere, it'll be like, I probably have one here. Let me see. Hey, they reported better than expected earnings on weaker revenues and they lowered their guidance. So that's 34%. What does that mean, lowered guidance? How much lower? In Snap's case, 100% lower guidance. Okay, it's fine to be like, hey, now they're not making money, but like, it's fine to be a public company and go, look, you guys thought, and we kind of agreed that we were going to make like $1 a share. It's going to be like, 97 cents now. We were a little off. Okay, we can weather that, but if you're 100% off, to me, that's the trouble there. He's going back for more. Yep, there you go. You good now, bud? All right. Chipotle. We talked about this a little bit yesterday. This was interesting, I thought, because for a food business, their margins were up. Not by a lot, but it was 0.6%. But for a big company like this, that's a lot. So sales up 8% and margins were up. Paper costs, right? The bags, all of the tray, the little indented tray that you get there. All of those costs lower. So they got more sales. They're able to raise prices. They admitted to that. Have lower costs. Okay. You earned yourself a 7% gain to new highs, and one of the bigger moves that Chipotle's had in quite a while. Okay, moving along. I told you, there's a lot of them. What do you want me to do? So Alibaba reports earnings here. So Alibaba as a whole missed on earnings, and essentially all that really happened was, oh, you can't see. We take yesterday's rumor and reprice to today's news. That is essentially what happens. That's why, like I mentioned yesterday, I don't like participating in stocks that have political news driving events, because today we have an actual fundamental, like, results from the company news event, and we repriced everything that was gained yesterday. I don't like that. That is the exact definition of the response I gave to somebody yesterday of why I wouldn't participate there in Chinese stocks just because of this news and rumor. All right, let's try this game again that we did yesterday. All right, CDW. So they come out with earnings better than expected, blah, blah, blah. They're buying back $750 million worth of shares. That's all people need to hear at this stage in the economic cycle, right? This has to be like 40 to 50 times now that I've shared this with you, in addition to the data and everything. It is the cycle of how people want to see a company spend their money in this type of economy, this type of economy. Told you I like Yum China. I just think it's a cool stock. Used to be a fun day trading stock. Earnings, blah, blah, boosted dividends, blah, blah. Oh, we raised our buybacks to $1.25 billion. That'll do it, right? Here's my question. And this took me off on a very, very far side tangent here. What happened to the 1% surcharge on corporate buybacks? I get that it may not apply to this particular ticker symbol, but every day this week I've been saying so-and-so buying back their stock higher. So-and-so buying back their stock goes higher. Buyback stock goes higher. But you get what I'm saying? Are we just not, like, are these companies not concerned? As 1%, remember the Secure Act put in that, said, no, if you buy back your stock, 1% is going to be a tax. This is your lesson of the day. Treat your money like corporations treat their money. And I know somebody always disagrees with that, but show me where I'm wrong, right? These people are all buying back their shares, and nowhere, I think it's Form 740, nowhere does any of them fill out Form 740. So it's the law, but yet they're getting away with it. So I had to look into this a little bit. I'm just going to read one little thing for you here. Let me see if I can find it. So as far as the repurchase tax rule here, just tell me if you understand what this is. So I actually found the IRS guidance here. Find yourself down on page 3 going into page 4. If you get this, automatic winner, right? The acquisition of any stock of a covered corporation by a specific affiliate of the covered corporation from a person who is not the covered corporation or a specific affiliate of the covered corporation is actually treated as a repurchase of the stock of the covered corporation by the covered corporation for purposes of the stock repurchase excise tax. That, my friends, is the loophole. It took me 52 pages to find it. It was on page 3 and 4. So the loophole here is, yeah, they don't care. They just got the guidance on how this works, and every single person can find themselves outside of either the specified affiliate of a covered corporation, the person of a specified affiliate of a covered corporation, or the special affiliate of a covered corporation to repurchase a stock. Yeah. The reason I say treat your money like the corporations do is that's 52 pages for pro-level CPAs, accountants, whatever, their HR departments to look at. What just came out the other day, I did a whole class on it for clients, the American Child Tax Reduction Relief thing, right? That was 7 pages. I went through those and broke it down and said, okay, fine, you're going to get $200 more in your child tax credit. Where's the juice? Where's the other stuff, right? The other stuff in there that's not anything to do with that law. There's always a way to treat your personal finances like a corporation and stay within the law. So side lesson, I know that's not stock related there, but whoa, right? And I read that thing. I mean, when I found that part, I was like, okay, think about this. They define each one of those, and I'm like, oh, that's how you did it. I tip my hat to you. Very well done. So I don't make the rules, don't get mad at the messenger. I'm just telling you, that's why you don't see people going $1.25 billion worth of share buyback. Got to give that 1% to the government. Say anything. All right, if you have any questions, I'll take your questions. Otherwise, I'm going to get back to doing the goods here, the things that I like to do and helping clients and all that fun stuff. And let me see if I can pop this out. Get you back over here, and Here we go. MW coming with 4 ads today. Is that a normal or is that a lot? Oh. We might make $7. Well, hey, thanks for, sticking around through the ad. You know what I mean? Market access, that is the definition of, hey, it's a company that has, they call it a moat, right? There's not many people that are going to compete. There's pretty much nobody that can compete with market access. It doesn't make any sense. And why would you do it? So here you go. You got market access. And then everybody's like, oh, wait a minute. Jim Cramer said they got a moat, right? They're going to be great. Yeah, but they're not worth all of that, right? Just because you're competitive and have, I'm not going to say a monopoly, but because no one else is really out there, it doesn't mean you can treat the company like garbage and still like spend a bunch of money. So that's the really layman's terms of what's going on there. No ads for DIM. Can we push ads out to individual people? Hit them. No, we don't. We have no control over that. Honestly, sorry. Like during the stream, just giving you. Oh, thank you. $7. You know what I mean? And don't get you fired at Chipotle. Tell you that much. Oh, MW's watching picture in picture. Cool. Okay. Yeah. Huh. Hey, what do you say to someone getting into a high market like right now? Well, high is relative, right? Depends on how you're going to define high. For me, I define the market as high in the very short term, right? And it just, you can look at it, right? There's no magic sauce there. I like to get in on pullbacks, and I don't care, right? I'll explain this a little bit. I'll occasionally get a client that says, hey, I've been holding on to a little bit of cash, and I'd like to invest it. Should I invest it when the market falls 2%, 3%, 10%, 20%? What am I waiting for? I know I want to buy a discount, but how much is a discount, right? And the answer to that is you don't look at the index to determine what you may buy. The index, as you now know, can keep going higher, but what we just showed yesterday, more and more stocks are falling below their 50-day moving average. So there's discounts to be had. Now, maybe that's not your favorite area, or those stocks that you want to buy are not falling, but don't judge a discount based on the index when what you're really wanting to buy is over here and is a part of the index, but not really moving along with it. So it's a tough one to put an actual percentage to it. But I hope we get it. So to answer your question, what would you say to somebody buying in the market like right now? I would say break the market up. If you're eventually going to buy the S&P or the NASDAQ or Russell or whatever, take a moment and break it into pieces and go, I'm not going to chase those. I'll eventually buy them. But right now I'm going to go over here. This is discounted. I'll take a little bit of that. And I was going to have 5% of it, so I'll put 5% in there. Oh, look, this is pulling back. Okay, I'll take that one out. And build your way into, if you're an index fund person or whatever, just build into it when the market's high. You don't have to run away and sit and wait on your hands. That's pretty cool. February normally strong till the middle of the month, then starts a little weakness historically. Yes, that is correct. MW is 100% in small cap value, and man, it's been rough till recently. Still yesterday was pretty good for you. Yeah, that's true. Pretty close to the Qs and SPYs and start investing. Can't be too mad. Yeah, and you can't look at those things, those brief moments in time where you're like, I'm only up 1%, but that's up 4%, right? If over your lifetime, you're like, hey, I'm pretty much trending right here. I'm hanging with the big boys. Okay, fine. Don't let these little ones trick you, because all of a sudden, you know what? From experience, you'll find yourself with more cash, and everything starts leaving you in the dust, because for that one brief moment in time, there was a little divergence between your performance and everybody else's. Yeah. Let the stocks choose you. I like that. Yeah. PayPal. Oh, yeah, they did. So I have not looked at the actual, I can see what the stock's doing, but I haven't looked at their report there just yet. So you're looking at about $60, give or take a little bit for the pullback there. I just picture it. We're at 63 on the close here. I'll go down to 60 and change. Just drop my cursor in here somewhere. Just picture that tomorrow, right? We open somewhere in here. You're wiggling around. Is there anything that tells you it's a buy or a sell? Not knowing what the earnings are at the moment, right? If you asked me this tomorrow and I see the stock there and I had no idea what was going on, I would still say it seems directionless. Like it's trying, but in the very short term, it seems directionless. And I don't know that I want to put money into something and then just hope I got a good price, you know? So that's where I'd be at with that one there. Uh-oh, Dim got the ad. Dim got hit with the ad. So it says, slow and steady man. Hey, man, I like that. Do you have any general investment tips for investing a large HSA? Good for you. Currently $18K in a money market for deductibles, but not sure what to do with the rest. Okay, so you've really gone for it here in this HSA. Good. So for me, and this applies even despite the balance, if your HSA gives you all those tax advantages, I want as much growth as I can get out of the HSA. And I'm willing to go through the volatility and ride the Bronco all day long if it means I get more growth because it's tax-free. It grows tax-free. I got my deduction on the way in. You get it. You know how an HSA works. You're obviously a pro. But to me, I want everything. I don't want bonds. I don't want to move slow and steady. I need the money for the medical expenses, of course, like you did. I want to go for it. That may not be the best approach, but to me, it's not your 401k. You know, it's not some big brokerage account. So it's pretty cool. Yep. Look at that, man. Beautiful. All right. Well, I appreciate you watching the ads. I hope they're good ads at least. You know, we don't get to control any of that, but I have a feeling it's based on what you browse for. So, yeah, good luck with that. Okay, I'm going to wrap it up. I got to go. Enjoy the rest of your day or evening. Thanks for hanging out with us, and we'll see you tomorrow.